Hello and welcome to the look ahead for Friday, the 27th of September with me, Fiona Cincotta, Senior Market Analyst at City Index. So overnight, we'll be watching out for Tokyo inflation figures. And we've got in the Eurozone, consumer confidence data, as well as a speech from ECB Chief Economist Philip Lane. Then in the US session, we're watching out for US core PCE, the Federal Reserve's preferred gauge for inflation, as well as the University of Michigan sentiment. So I think the focus has been most of this week and will be on the US core PCE data, which is expected to show that inflation ticked slightly higher to 2.7%, up from 2.6%. But I don't think that's really going to cause too much of a problem as far as the market's concerned. We have been hearing from several Fed speakers across this week who have said that they're comfortable and confident that inflation is continuing to fall towards the 2% target and that the focus should shift towards the jobs data instead and the health of the US labor market. So, I mean, the other thing to be watching out tomorrow, I think, is that University of Michigan confidence figure. Obviously, we've had weak consumer confidence out this week. So there are some concerns that that slight cooling in the labor market is starting to impact consumer sentiment. Now, here we're looking at gold. Gold has risen to fresh all-time highs today, reached a record level of $26.85 per ounce. The gold's being supported by several factors here, not only the prospect of more Federal Reserve interest rate cuts, globally lower interest rate environment, which benefits non-yielding gold. But then you've also got the prospect of the idea that central banks are very much buying up gold. And we've also got this idea as well of economic uncertainty. I think, there are some concerns about the outlook as far as the global economies are concerned, particularly in Europe. There might be concerns over the slowing economy and a recession potentially in the US. At the moment, the data isn't showing that though. And then also you've got the safe haven flows on as sort of geopolitical tensions escalate, and you've got the uncertainty surrounding the US election. So there's quite a lot that's been sort of boosting gold prices higher. However, we can see here it's very much in overbought territory. And even if we look out to the different time scales, that's on the weekly chart as well, it's overbought. And even on the monthly chart as well, it's overbought. So there is a potential there that we're going to see some consolidation or a pullback in gold prices to get the RSI out of overbought territory. As far as support levels are concerned, 2600, that's going to be a level that's on the rising trend line support that goes back to 2022. Then below that, we'll be looking for around the 2530 level. That's 2550, 2530 zone. That's sort of the late August high. It's also the low that we saw in mid-September. So those are sort of the levels to be watching out for on the downside. And then below that, 2475, but we're really quite some way from that as we speak. I think over the medium time, though, I think that gold still has the potential to move higher. Obviously, it's not going to be in a straight line, but I think those factors are supportive for gold as we go out into the medium term. The other one just to be taking a look at here is with relation to the US interest rates and the Federal Reserve and what's expected. Obviously, the market has been pricing in high levels of expectations of another 50 basis point rate cut from the Fed in November. That was up at 63%. A little bit earlier today, with the rest sort of going for a 25 basis point rate cut. The prospect of a lower interest rate environment is obviously beneficial to these stocks, and also the prospect of a lower interest rate environment is beneficial to stocks such as the Nasdaq and other US firms. And that's helped push the price higher, particularly whilst the data isn't showing that the labour market is collapsing in the US. We are seeing a cooling, but we're not seeing by any means a collapsing. So, unless the data comes in showing that there is a reason to be concerned about the health of the US economy, then that does mean that potentially there could be more upside. But we are just having a few problems getting over this 20,000 level. So we've seen a breakout of this symmetrical triangle on the Nasdaq, a rebound from the 200 SMA. Just trying to get above that 20,000 today. We've got that long upper wick on the chart suggests there wasn't much buying demand on those upper levels. Now, buyers are going to need a close above 20,000 in order to rebring 20,750, the all-time high, back into focus. Failure to get up here could see a rebound lower, and then we'll be looking really back down towards the 19,000, just at 19,200, which is that falling trend line support. Now, I also mentioned we've got consumer confidence from the Eurozone, also ECB. Chief economist Philip Lane is speaking. This is the Euro US dollar chart at the moment. Again, we can see there's consolidation around the 112. The price seems to be struggling to get above that. Obviously, there are factors that are weighing on the euro. You've got sort of the benefits that the euro is capitalizing on the weak US dollar. The US dollar is trading down at a 14-month low versus its major peers. So the euro is being able to capitalize on that. The Fed is going bigger on rate cuts. Seems a little bit more aggressive as far as rate cuts are concerned. So that ECB Fed divergence has also benefited the euro. But there are concerns over the health of the Eurozone economy, particularly in Germany. We've seen a lot of weak data recently from Germany, and concerns over the growth outlook. Growth was downwardly revised at the ECB meeting. So those concerns, I think, are just preventing the euro from passing that 112 level, which is needed in order to push back up to this level up here, which is the level that we saw at the 2023 high, which is at the 1275. So that's going to be your targets on the upside. Downside, you've got this support here, pretty much what we're testing at the moment, around the 111.50, break below there, 111 on the round number. For a lower low, it needs to break below that 110 level. Let's just also take a look at US dollar, Japanese yen. Obviously, as I mentioned, we've got the excuse me. We've got the Japanese Tokyo inflation, which is due out later today or overnight. In fact, it's expected to show inflation ease. Core inflation is 2%, down from 2.4%. We've also heard from the Bank of Japan, who actually just seem to be backpedaling a little bit as far as their rate hikes are concerned. They're not so much that they're showing that they're not really in a rush to move again, not as much the rush as the market perhaps initially thought that they might have been. And because of that, we've seen this rebound in the US dollar, Japanese yen, amid some weakening in the yen. Just testing now that 145 level. That's the level that it needs to rise above in order to test 147, which is the September high. So if we get stronger than expected inflation, maybe we could see a rebound in the yen, which may see a retest of that 141.70 level, which was the August low. And beyond that, then we'll be looking down here at the 139, which was the September low. So just final one that I want to be having a look at is oil. Oil has fallen really sharply over the past 2 days, down around 5%. Basically on a couple of reasons. There's concerns over the demand outlook. There were concerns that the sort of China stimulus maybe wasn't as big as what the market was hoping for, but then we did have that second announcement today over Chinese stimulus, so that should have sort of supported that. But I think actually here the big driver of this sell-off has been the news that Saudi Arabia are abandoning their $100 the barrel target for oil, which basically suggests that they're now accepting the idea that we're going to be in a lower oil price environment for the time being. They're still planning to ramp up production as from the 1st of December. That was meant to happen on the 1st of October. where the OPEC Plus was going to dial back, unwind some of those production cuts that they've had in place. That got held, put on hold for early October start. It's been pushed back, but it will be going ahead in December, despite the fact that we are seeing sort of, weaker oil prices. So it's almost as if Saudi Arabia, the largest oil producer in the world, is just coming to terms with the lower price oil market, and well, that's upset some oil traders, to say the least. So as far as what we'll be looking for, we saw a rejection here at this level that we've been watching, the 71.50, 72.50 zone that we've been talking about. We faced a rejection there. We're back down now here, testing that 67.30 level, which is the level that we saw back in December 2023. Now, if we do get a break below that, this is going to be the next one on the downside, the 65.25 level that we saw in September. Obviously, on the upside, if we do, we need a break above that 71.50, 72.50 level in order to get a higher high. So thank you very much for watching. I hope you've liked what you've seen. If you do, then please do give this video a like and press follow for more videos like this.